All right, let's go to Paul Christopher. He's head of global investment strategy at Wells Fargo Investment Institute to talk a bit more about the markets today. Thanks for joining us.
Sure.
No big leaps and bounds on the major North American markets today with the decision to hold the rates both here in Canada and the U.S. Do you think it was the right decision for the Fed?
Well, the Fed is really in a bind because they've got steady inflation and some improvement in the labor market, so they really don't have a lot of cover to cut rates here. That's their reasoning. We do see improvement in the labor market. We do see improvement in the U.S. economy going forward. So we think the room for cutting rates is probably less than it was last year.
Okay, the S&P, though, is still strong, a little off that 7,000 close mark. Where is the strength of the U.S. economy coming from?
So it's going to be coming from spending, especially on services. And then the second sort of leg of spending, if you like, is all that technology spending. And people talk about artificial intelligence, but there's a lot of automation that's going on, and not just to cut jobs, but there's automation going on that improves the quality of products in places like biotech and pharmaceuticals. So there's quite a lot of that spending going on, and that's what one company spends is another company's revenue. So those two, I think, are the strong drivers for the economy this year.
So, Paul, do you have any concerns about a partial government shutdown?
No, not really. I mean, it's sad to see it happening once again. We can't seem to get the 2026 budget completely in the books. But look, for investors, let's take some solace here. They still have they have some of the budget bills passed, so it's not a complete shutdown. And they probably, in a midterm election year, don't want to stay shut down for very, very long. So we think the markets will generally look past this one.
Okay, you mentioned the tailwinds that you see this year. Do you still think the labor market will hobble along this year, or do you see some gains there as well?
Gains there as well, but not sort of giant, 150,000 sorts of jobs per month. Not those days are behind us a little bit. But we do see some stability in the labor market here going forward. Especially small businesses have been indicating for the last 5 or 6 months that they intend to hire more coming into 2026. Lower interest rates, the lower interest rates we already have, should help quite a bit in that direction.
You mentioned the big tailwind of AI and the CapEx spend for some of those bigger companies, the hyperscalers. Are you pivoting that tech investment at this point? Where are you putting it? Because it's anticipated it'll be a tailwind this year, but maybe not as big as it was last year.
Well, yeah, maybe not as big as it was last year, but remember last year it was a multiple story. It was a story about people paying up for something that they thought was going to be a long-term trend. We do believe it will be a long-term trend, but now we need to see the earnings come through. And fortunately, the earnings growth that we see is more broadly based in the S&P 500 this year. So it's going to be, we think, an earnings-driven year with broad-based participation across the sectors. And you can see that in the recent market performance where the cyclicals have really dominated sectors like energy and materials, industrials. So we expect more of that to come. We think tech will find its own way.
Okay, but are you managing the tech stocks any differently this year from last?
No, not really. Look, we think the trend has legs. When I say the trend, I mean the trend in spending on capital equipment. We don't know yet what the adoption rates of AI are going to be or of automation, but we can see very clearly in company guidance that the spending rates are intact, and we're going to try to play that trend, but we won't overpay. So last year we got into tech and communication services early in the year after DeepSeek. Remember that? Pushed tech stocks way down. We bought into that, went overweight those sectors over their market weights. And then when they got to be 30, 35 times 12-month expected future earnings, we said, that's a little bit expensive. Let's take some profits and roll that money into trends that we think are ancillary or subsidiary to the main tech trend. So you might think of data centers, for instance. And all of this automation that's going to be coming our way is going to require a lot of power. That's going to mean rebuilding and redoing, renovating a lot of the power generation and power transmission across the country. And so industrials and utilities were pretty good picks for us last year. The utilities have suffered a little bit lately. We still think that's a good pick. It's a good time to buy. And then the third pick would be financials. Financials with the steepening yield curve, with more companies seeking to borrow, especially to fund tech purchases. We think financials will do well this year. They also have struggled lately, mainly on policy anticipation. for example, the interest rate cap on credit cards. But we think that's going to be a good play for the longer run, and we would still favor the financials, industrials, and utilities.
How are you looking at fixed income these days?
You know, the long end of the yield curve looks pretty volatile right now, and it's that way around the world. If you think about German bunds or the French or the Japanese government bond yields, the Japanese government bond yields moving a quarter of a point in such a short period of time hasn't happened in years and years. And we're seeing the 30-year U.S. Treasury also move higher. So we think you're going to see some ups and downs in that 30-year in the long end of the yield curve as we move forward. And of course, that's where investors have the most vulnerability to yield changes because of the long duration, the long maturity of these bonds. So we're favoring the middle part, the intermediate part of the yield curve. A 3, a 5, a 7 doesn't get you a yield that's a whole lot lower than a 10-year, but you have a lot less exposure to that rate volatility.
All right, I do have to leave it there. Paul, thanks for joining us. Paul Christopher, Head of Global Investment Strategy, Wells Fargo Investment Institute.